Hey guys, welcome back to the channel. So conventional wisdom tells us that assets are something you want to acquire because assets produce income or generate wealth. And you should also stay away from debt because that's a liability. And liabilities are bad because your wealth is the difference between your assets and your liabilities. You take what you have and you subtract what you owe, and you get the net worth of what you have. Pretty straightforward, but what if real interest rates are negative like they are today? Well, now we have to re examine those basic financial concepts because when real rates are negative, traditional assets such as bonds turn into a liability, and low interest debt is no longer a liability. It has turned into an asset because it increases your real wealth. So, in today's video, I'll explain why this is happening, how we got here, and where's the best place to put money when real rates are negative. Interest rates have a huge impact on personal finance, particularly real interest rates. Real just means taking inflation into account. For example, if you have a fixed income asset that pays you 3%, but at the same time inflation is at 2%, then the real interest rate of that investment is 1%. In other words, you can afford to buy only 1% more stuff than before because the cost of living has gone up. And here's the thing, real interest rates can even go negative. This happens when investments give a lower return than the inflation rate. Here's a chart showing the difference between the 10-year government bond yield and inflation. So the line has been slowly trending downwards for the last 40 years, and it has recently gone negative. In fact, as of last month, the real interest rate was negative 2.17%. Why is this significant? Because it means that if you're holding bonds, you are losing about 2% of your purchasing power every year. Here's a real world example. The popular fund Vanguard Total Bond Market ETF saw virtually no capital appreciation over the last 5 years. Traditionally, this would actually be fine. Fixed income investors put their money into bonds primarily for the regular cash distributions, not for capital growth. But of course, now is different. This bond fund is only paying investors just over 2% a year, but the current inflation rate, as measured by the Consumer Price Index, is at 5%. This means anybody who buys this bond is actually losing 3% of their purchasing power. As we know, liabilities are things that make you poor, and in a negative rate environment, fixed income investments such as bonds can slowly decrease your real wealth. This essentially makes them liabilities instead of assets. So if somebody has a 50% asset allocation to bonds, then basically half of their portfolio is dragging down the other half. They're probably not going to get rich anytime soon. To be fair, I'm not saying you should sell all your bonds. They can be used strategically if you know what you're doing, but you should definitely rethink how much bond you want to own long term, especially if there's a chance that negative real rates are here to stay for a while. And even if you don't hold any bonds, you may still be affected by negative real interest rates. Mortgages and other cheap debts are usually considered liabilities. They charge interest, taking money out of your pocket. This makes it harder for you to save money and build wealth. But today, the opposite is true. Holding a mortgage will actually increase your purchasing power because the interest rate you pay is lower than inflation. To demonstrate how this works, pretend your friend wants to borrow money from you to buy a house. He'll pay you back a year from now and he'll pay you a 20% interest rate. You decide to lend him the money because a 20% return on your investment sounds pretty good to you. A year later, he pays you back the original principal amount plus 20% more as interest payment. All good. But here's the problem if real interest rates are negative. Let's say during the year inflation ran really hot at 100%. That basically means everything costs twice as much. So, yes, you have 20% more money now, but the money you got back is worth only half of what the money you lent out was worth. Meanwhile, your friend's house doubled in price keeping up with inflation. So, who ended up more financially ahead here, you or your friend? That's a bit of an extreme example, but I hope it gets the point across, which is that in a negative interest rate environment, the borrower benefits more than the lender, assuming the borrower doesn't squander the money he borrowed. So if you get a mortgage, then the cost for you to service that mortgage is less than the value you get from inflation eroding away your mortgage balance. This means you will earn a real return on your debt. Thanks to negative interest rates, holding a mortgage produces wealth net of inflation. And since real estate tends to be a great store of value, you can potentially create real value from both the property itself and your mortgage. This creates a double compound growth effect, which I've explained in a previous video, and it's how a lot of people build wealth relatively quickly. No wonder home sales have gone through the roof this past year. Even Ben Bernanke, who used to chair the Federal Reserve, still keeps a mortgage despite being a multimillionaire who can easily pay it off anytime he wants. If you're ever confused about what to do with your money, just look at what the bankers who designed the financial system are doing with theirs. So, as you can see, negative real interest rates have overwhelming consequences for everyone. In this backwards environment, debts behave like assets, and fixed income investments lose value like liabilities. This is the reality of negative interest rates when economic growth is slow and inflation is high. So, what can we do about it as individuals? How can we protect our finances going forward? Well, to figure out what to do next, it's important to understand how we got here in the first place. And this wasn't an accident. Policymakers purposefully engineered this current situation. Why? Because it's politically expedient and allows the government to borrow and spend without requiring any financial discipline or responsibility. Governments can borrow money today and pay it back later when that money is worth less. The good news is regular folks like you and I can also take advantage of negative interest rates. I can't give any specific advice, but here's what I'm personally doing with my finances. I'm reducing my bond exposure and buying more assets that have historically protected investors against inflation. I'm also borrowing against my investments on margin to buy high quality blue chip stocks. The dividend income that I receive is more than enough to cover the low interest rate of margin debt. I also try to pay down my mortgage as slowly as possible. This means going for a 30-year amortization and not making accelerated or lump sum payments. Right now, a mortgage behaves like an asset. It generates value after inflation. But in order for me to take advantage of negative real rates, I have to be patient and allow inflation to pay it down for me. I've also been buying some alternative investments, such as investment grade wine and cryptocurrencies. I feel like Bitcoin has finally found a bottom. It has been range bound for about a month, and most of the downside risks should be gone, so I recently added a bit more to my Bitcoin holdings. And finally, I've been buying stocks with strong fundamentals and healthy balance sheets. I expect an increase in shareholder friendly behavior for companies with a lot of cash reserves, such as Apple, Microsoft, or LVMH. I'm going to have a link down below in the description to all of the stocks that I hold. I'm pretty happy with the performance of my non registered account so far this year. I think it helps to understand interest rate policies and stay ahead of the market. My strategies tend to change when policies change. As Albert Einstein once said, the measure of intelligence is the ability to change. That's why I accumulate more debt when rates are low, and I pay down debt when rates rise. So continue to pursue your own financial goals, but stay flexible in your approach. As you can see, interest rates are very powerful and they're worth paying attention to because they can dramatically change the balance of your entire investment portfolio. Anyway, thanks for watching. I'm Liquid. As always, I hope you're able to get something informative out of this. Let me know if you have any subjects you'd like me to cover in a future video. I'd be interested to know what personal finance topics everyone else is interested in. So have a good one, and until next time.